This is Chapter 12 from Income Tax Planning. So we talked about asset categorization in chapters 10 and 11, but all assets are capital assets except for ordinary assets, which are accounts receivable, creative works, and inventory, and then Section 1231 assets, which are depreciable real and personal property held for the use in trade or business. So this could be rental property, machinery, equipment, those kinds of things, a vehicle. So ordinary income assets, gains are subject to ordinary tax rates and losses are subject to ordinary tax rates and unlimited. But if it's a capital asset, long-term gains and losses are subject to special tax rates and long-term losses are limited. If it's a Section 1231 asset, gains are capital and losses are ordinary. So let's talk about what Section 1231 and corporations. Corporations do not get favorable tax treatment for capital gains. Ordinary losses may be deducted in full, and so there's no special capital gains rate, so everything's ordinary tax rates. The catch, the depreciation rule. If Section 1231 applies, you must check to see if depreciation taken will have to be recaptured. Depreciation example is Randy, a highly sought after financial planner in his community, opened a new office several years ago. He purchased computers for use by his staff, and the computers were classified as 5-year class life property. Over the next 6 years, Randy and his staff used the computers, at which time they were replaced with new machines. The old machines were disposed of at no value. Randy was able to cover the capital investment in his computers over the 5-year class life through depreciation expense deductions, which were deducted as ordinary income. He received nothing on disposition, so consequently, the disposal of the computers do not trigger income tax consequences. Why is depreciation recaptured? So depreciation is a form of capital recovery. Ideally, depreciation equals actual economic decline of the value of the asset. For tax purposes, depreciation follows a set schedule, regardless of actual decline in value. When an asset is sold, the depreciation recaptured first to represent the excess depreciation taken greater than the economic decline, if any. Then Section 1231 applies. Let's talk about, so Section 1231, there's different types of property. Section 1245 is tangible property, machinery and equipment. Section 1250 is real property, building and structures. So there are several steps to determining the tax consequences of Section 1231 assets. Step 1, categorize the asset as Section 1231. Step 2, calculate the gain or loss. Step 3, consider depreciation recapture. If it's personal property, Section 1245. If real, Section 1250. Apply the best of both worlds rule. So, depreciation is recaptured as ordinary to the extent of any gain. All depreciation must be recaptured before capital gain treatments under Section 1231. So, an example has 4 possible outcomes. All right. So if the amount realized, AR, equals the amount adjusted basis, AB, then there's no gain or loss. It's basically equal, resulting from economics. So accounting estimates of depreciation equals economic reality. If there is amount realized is greater than is less than the adjusted basis, then the resulting loss is always treated as an ordinary loss. Not enough depreciation was taken as the example. Now, if the amount realized is greater than adjusted basis and the gain is less than depreciation, then Section 1241 treatment as the gain is ordinary. Too much depreciation was taken. Now, if the gain up to the amount of depreciation is taken is ordinary under Section 1245, and then the gain in excess is treated as capital, too much depreciation was taken and the asset appreciated, not depreciated. So these are the 4 examples of what could happen. So let's talk about an asset, a 1245. Karen starts a lawn mowing business and purchases equipment for $1,500 for a lawnmower. Casey Casey took $400 in depreciation. He wants to sell the lawnmower to purchase a more heavy-duty piece of equipment. He can sell the lawnmower for the adjusted basis, less than the adjusted basis, more than the adjusted basis, or more than the original purchase price. Example, amount realized. If he sells it for $1,100 and his adjusted basis is $1,100, which was $1,500 minus the $400 in depreciation, then there's no gain or loss. If he sells it for $1,000, but his adjusted basis is $1,100, there's an ordinary loss of $100. If he sells it for $1,200, adjusted basis is $1,100, then he has an ordinary gain of $100. The gain is less than the total depreciation of $400. Then there's the final example. He sells it for $1,700, which is more than the original amount, right? His adjusted basis is $1,100. He has a gain of $600. $400 is ordinary due to depreciation. The remaining $200 is capital, which means the gain is more than depreciation he took. We'll do examples of multiple choice questions with this after. Depreciation taken is greater than straight line depreciation is recaptured at ordinary rates. So unrecaptured section 1250, aka straight line, is taxed at 25%. So an example, and this happens frequently because the building appreciates and you got to depreciate it on your tax return. So the excess amount, so the straight line is taxed at flat 25%, and the excess gain is capital under 1231. So an example, Lucas purchases an office building for $1 million. He's taken depreciation of $300,000. Straight line would have been $200,000 at the time he sold the building for $1.5 million. So his amount realized is $1.5 million. His adjusted basis is $700,000. He has a total gain of $800,000. How much of this is ordinary? So the first amount would be ordinary. This is the difference between actual depreciation and straight line. So that's $100,000. Then the amount of straight line, which is $200,000, is taxed at 25%. Then the remaining gain is taxed at capital gains rates. So yes, section 1250 gains are complicated because you must split it into 3 categories: ordinary, 25%, and capital. Gifts. So depreciation recapture potentially carries over to the donee. Non-depreciable exchanges. So depreciation recapture carries over to the replacement property. Or testamentary transfers. Section 1014, step up, extinguishes recapture potential. Charitable contributions. If a deduction is normally valued at fair market value, it must reduce the deduction by the potential recapture for depreciation. If there are installment sales, including SCINs and private annuities, installment reporting provisions do not apply to depreciation recapture. Recapture occurs when the gain is realized. Unrecaptured section 1250 depreciation may be deferred, but all of the gain in each installment will be taxed at 25% until straight line depreciation is recaptured. Also, there's a 5-year look-back rule. So in section 1231 netting process, gain and losses for the year are netted, all section 1231 property. Then tax planning. It would be better to recognize a 1231 gain in the year that you have 1231 losses. A 5-year look-back rule. Net section 1231 gain in a current year is taxed at ordinary rates to the extent of unrecaptured 1231 losses in the last 5 years. If a taxpayer had a 1231 gain in losses, so in 17 they had a loss of $4,000, in 18 they had a loss of $10,000, and in 16 they had a gain of $16,000. The taxpayer's 1231 net is $14,000 in ordinary income and $2,000 in long-term capital gains. The ordinary is because of the 2 losses in the year before. So Colin had a section 1231 gain in the current year of $15,000. In prior years, he had the following net transactions: a loss in 18 of 4, a loss in 17 of 2, no transactions in 16, 15, 14, an $8,000 gain in 13, and a $2,000 gain in 12. Colin would recognize $6,000 of his gain as ordinary, since in 18 and 17 he had losses. The remaining $9,000 would be treated as capital. And that's an overview of the slides from chapter 12.